Eurozone inflation falls below ECB target at 9%. OECD forecasts global GDP growth to slow to 2.9% in 2025 and 2026. And Turkish annual inflation eases to 35.41% in May. Welcome to the Economic Bulletin. We start off with Europe, where Eurostat has reported that Eurozone inflation is below the European Central Bank's target last month, underpinning expectations for another interest rate cut this week, even as global trade tensions fuel longer-term price pressures. Consumer price inflation in the 20 countries sharing the euro slowed to 1.9% in May, from 2.2% a month earlier. Prices, excluding volatile fuel and food prices, meanwhile, slowed to 2.3% from 2.7%, driven by a slowdown in services price growth to 3.2% from 4%. Bank of England Governor Andrew Bailey said Tuesday he's sticking to a gradual and careful approach to cutting interest rates, citing increasing global trade policy turmoil as a major source of uncertainty. The BOE cut rates last month to 4.25%, but Bailey noted the path for rates is now shrouded in a lot more uncertainty. He added that a cooling labor market and slowing pay growth are crucial for further cuts. Financial markets are now pricing in fewer rate cuts than previously expected, with only one fully priced by year-end. The Federal Statistical Office has reported that Switzerland's annual inflation rate registered a negative 0.1% in May, down from 0% in April, marking the first decline in consumer prices in more than 4 years. The Consumer Price Index itself saw a monthly increase of 0.1% to 107.6 points, driven by higher prices for housing rentals, international package holidays, fruit and vegetables, and stone fruits. Core inflation, which excludes volatile items like fresh and seasonal products, energy, and fuel, rose 0.1% monthly and increased 0.5% annually. The harmonized index of consumer prices used for European comparisons declined by 0.2% both monthly and annually in May. Representatives of member countries of the Organization for Economic Cooperation and Development have met in Paris for its Ministerial Council meeting as the body revised down its outlook for global growth. It added that the growth outlook would likely be even weaker if protectionism increases, further fueling inflation, disrupting supply chains, and rattling financial markets. OECD Secretary General Matthias Cormann highlighted that low productivity growth and rising trade restrictions would lead to lower growth if they were not tackled. He added that members needed to find better ways to make the international trade system work more effectively while also maintaining open markets and rules-based trade. The Organization for Economic Cooperation and Development has reported that global gross domestic product growth is projected to slow down from 3.3% in 2024 to 2.9% in 2025 and 2026. In its latest economic outlook, the OECD revised down its global growth forecast for the 2 years by 0.2 and 0.1 percentage points. It also forecast that the U.S. economy would grow only 1.6% this year and 1.5% next year, assuming for the purpose of making calculations that tariffs in place mid-May would remain so through the rest of 2025 and 2026. OECD warned that while new tariffs may create incentives to manufacture in the United States, higher import prices would squeeze consumers' purchasing power and economic policy uncertainty would hold back corporate investment.
We expect inflation in G20 economies over this year and next to decline more slowly and remain higher for longer than previously foreseen in our December 2024 outlook. The increase in tariffs will weaken growth in China, while fiscal measures such as subsidies for consumer goods help cushion the slowdown. We expect growth to moderate from 5% last year to 4.7% in 2025 and 4.3% in 2026. In the euro area, growth is expected to strengthen modestly from 0.8% in 2024 to 1% this year and 1.2% next year.
And for further analysis, we're joined from Washington by Justin Thomas Russell, Executive Director of the Global Foreign Policy Center of Washington. Welcome, sir, to Qnews Economic Bulletin. And first off, the OECD has revised down its global growth forecast for 2025 and 2026. So what key indicators or developments led to this downgrade?
Well, thank you for having me, as always. The reality is that one of the key factors is the trade wars, the tariff wars. Donald Trump and President Xi have literally caused a global economic downturn slightly, and that's going to be an issue for economies globally. This kind of proves what the Global Foreign Policy Center has forecasted, that this trade war is going to have a large ripple effect. And as we see in the numbers coming out of OECD, it's going to be a downturn. There's only a handful of countries that could possibly see an uptick, and they're not countries we normally expect, like Argentina, Australia, Saudi Arabia even sees an uptick, but the rest of the world is going to see a downturn.
But, sir, how concerned should policymakers be about the projected decline in global GDP growth to 2.9%? And is this part of a broader post-pandemic correction or a sign of deeper structural challenges?
That's a really great question, and I think that they're still trying to decipher the numbers on this. I mean, there's no question that that the economy was hindered by the recovery coming out of the pandemic. But what we're seeing now is kind of almost conflicting indicators, where we're seeing, for example, here in the United States, we're seeing record low unemployment, but we're seeing record growing inflation. That doesn't necessarily show any sort of recession or any sort of trend towards financial decrease. That being the case, I think what we're seeing is long-term local economic strategies, focused economic strategies that are going to have direct impacts in the larger global market. It's a ripple effect that is happening because we are in such a interconnected, intertwined global economy now.
Now, speaking of strategies, in your view, what are the most urgent policy measures needed to counter the slowdown?
The number one is dealing with trade and tariff wars. Trade and tariff wars do not help anybody. Trade and tariff wars are a problem, and all that does is exacerbate economic stress. Until we start looking at stop looking at it from a nationalistic perspective and looking at it as an interconnected global economy, we're going to have a problem. And this is one of the key factors that every economic power, whether it's a G20 power or an expanding market, that's got to be the case.
Since you've mentioned G20, so Secretary General Corman mentioned that inflation is expected to remain higher for longer. So what are the main inflationary drivers across the G20 economies today?
Well, again, everything turns back to trade, tariff, and trade wars. If you look at the infighting that's happening within the G20 members, for example, the United States and Canada, United States and Mexico, United States and EU, just the fact that the G20 is infighting, and that there's concerns that, the BRICS alliances could be impacted as well. You're talking about the largest global economies that are on the brink of seeing an economic downturn that's going to affect everybody, with the exception of, and this is still surprising to me, we're going to see Argentina with the largest growth out of all this. That makes no sense to me. But again, when we talk about the G20, they have to stop fighting amongst themselves unless we're going to continue to see downturns in economic growth.
Now, regarding central banks, how can central banks balance the need to control inflation without triggering further economic slowdown?
Well, central banks have to work trying to put political pressure on Jerome Powell, the chairman of the Federal Reserve Bank here in the United States. And Jerome Powell has done a really good job of keeping arm's length away from being brought into the political fights. That needs to happen globally. If you are the head, if you are the chair of a central bank, if you run a central bank or even a member of a board of governors of a central bank, you have to remove yourself from being politicized. It has to be done on strictly hard numbers that are in the best interests of your economy. The second you bring in politics, as we're seeing in the United States, it's going to become a larger problem globally.
Now, moving on to the OECD, which warned that increasing trade protectionism could further weaken growth and rattle markets. Are we seeing a new era of deglobalization, or is this a temporary policy shift?
I think that's unclear right now. Here's the problem, is we have grown into a global interconnected community or a global interconnected economy that relies on just-in-time logistics and cheap goods sourced from outside of, traditional market areas. Example, you look at the United States and China. We've come to the conclusion at the Global Foreign Policy Center that we're in a state of mutually assured economic destruction where we get into a trade war, and the U.S. consumers who have become so spoiled and entitled with cheap goods like electronics, clothing, etc., they've become so entitled and so reliant on cheap goods that China needs that in order for them to get economic stability and economic growth. Because if we stop buying those products, their economy is going to get hit. And if that economy gets hit and it affects our economy, the ripple effects of all those economies are going to be sucked into what we're seeing now out of the report, a possible global economic turndown.
Mm-hmm.
That being the case, we have to come up with solid, set economic and trade policies that do not become confrontational, but look at the overarching future of what our global economy is going to look like. We have no choice. We are at the point of no return. We have to understand that, for example, here in the United States, Donald Trump has been talking about building all these factories and manufacturing all these things, all these high-end products. We can't do that right now. We don't have the infrastructure or the trained workforce or the ability to have facilities ready to go in just-in-time requirements to build these things.
Mm-hmm.
That being the case, we're still going to have to buy stuff from our trading partners.
Which brings me to my next question, actually. What kinds of reforms or better ways can we make the global trade system more effective while preserving open, rules-based trade as suggested by the Secretary General?
If I had an answer to that question, I'd be very rich right now. I don't think anybody really has an answer. Because what we've seen is, we've seen one of the largest economic superpowers in the United States just throw blanket tariffs at everybody. That being the case, when you start weaponizing tariffs and trade, that becomes a situation where it causes global economic concern is, does the United States become a unstable trading partner? You look in the case of like Canada, you look in the case of the EU, there's nothing saying that the EU or Canada or even Mexico has to trade with the US. They can trade with China, India, Brazil, other manufacturing hubs and other trading partners and other global economic powers. Or in the case of the EU, they could possibly trade amongst themselves. We're seeing this in Africa, where Africa is starting to become hyper independent. But what that does is it takes away the economic power, buying power of those markets when it comes to creating a solid and stable trade alliance with a global powerhouse like the United States.
Mm-hmm. From Washington, that was Justin Thomas Russell, Executive Director of the Global Foreign Policy Center of Washington. Thank you so much, sir, for your insights and for joining us here on the Economic Bulletin on Qnews. Now moving to the United States, the Labor Department has reported the U.S. job openings increased in April, but layoffs picked up in a move consistent with a slowing labor market amid a dimming economic outlook because of tariffs. Job openings, a measure of labor demand, rose 191,000 to 7.391 million by the last day of April. Hiring increased by 169,000 to 5.573 million in April. Layoffs rose 196,000 to 1.786 million. The unemployment rate is forecast to hold steady at 4.2%, with greater risks of a rise to 4.3%. Atlanta Fed President has stated that the strong economy gives the U.S. Central Bank time to evaluate how tariffs affect inflation and growth, while keeping the door open for one interest rate cut later this year. He added that the best approach for monetary policy is patience to see how the heightened uncertainty affects employment and prices. He noted that there are many ways the tariffs could play out, and it's possible they might simply drive one-time price increases that the central bank can look through. He further said that so far there is little evidence tariffs have pushed inflation up, and that the data seen on the economy has been pretty good despite gloomy sentiment measures. In Asia, Bank of Japan governor has stated that the country's economy can withstand the hit from U.S. tariffs and sustain a cycle of rising inflation accompanied by wage growth. He also signaled the bank's readiness to raise interest rates once it's convinced enough that economic and price growth will re-accelerate after a period of stagnation. He warned that recent tariff policies will exert downward pressure on Japan's economy through several different channels, adding that corporate and household sentiment is already worsening. He also added that Japan's tight labor market means the economy will likely sustain a trend in which wages and prices rise in tandem, a key prerequisite for further rate hikes. Taiwan Semiconductor Manufacturing Company's chief executive C.C. Wee has stated the U.S. tariffs were having some impact on the company and had been discussed with Washington, but demand for artificial intelligence remains strong and continues to outpace supply. He added that the company had not seen any changes in customer behavior due to tariff uncertainty, and the situation might become clearer in coming months. We emphasized that TSMC had been talking to the U.S. Department of Commerce about tariffs, expressing concerns that levies could increase production costs as some equipment purchased from U.S. suppliers is made in Asia. In Africa, Livestock Minister Edi Mahia has stated that Nigeria is importing Danish dairy cattle as part of a plan to double its milk output to 1.4 million tons annually within 5 years. This initiative aims to cut the country's $1.5 billion yearly dairy import bill, which currently covers 60% of its consumption. Mahia has stated that despite a large cattle population, current breeds yield low milk output. In the MENA region, Director General of Dubai Chambers, Mohammed Ali Rashid Luta, has reported that Thai direct investments in Dubai have reached approximately $626 million over the past 5 years. Luta expressed optimism for continued growth, citing ongoing efforts to deepen economic cooperation. Thailand is highlighted as one of Dubai's key trading partners within the ASEAN region. Non-oil trade between Dubai and Thailand has seen significant growth, with the volume projected to reach approximately $6.5 billion, a 23% increase from $5.3 billion in 2023. The Turkish Statistical Institute has revealed that annual inflation dipped a bit more than expected to 35.41% in May, less than half the level that it reached a year earlier, as tight monetary policy continued to slowly cool price expectations. Month-on-month consumer price inflation was 1.53%, also below forecasts. In April, inflation stood at 3% on a monthly basis and 37.86% annually. Annual increases were led by education prices, which were up 71.67% on the year, while housing prices climbed 67.43%. Food and non-alcoholic drinks prices rose 32.87%. Spain's defense ministry has officially cancelled a $325 million contract with an Israeli firm for anti-tank missile systems. The decision is part of Madrid's stated effort to reduce to zero its technological dependency on Israel amid ongoing war in Gaza. The contract, awarded to PAB Technos, a Spanish subsidiary of Rafael Advanced Defense Systems, will see Spain now consider the US-made FGM-14-8F Javelin as an alternative. This follows a previous cancellation of an Israeli-made bullet order and signals a broader policy of disconnection plans to reduce reliance on Israeli defense technology. Oman has posted a fiscal surplus of 540 million Omani riyals in 2024, significantly outperforming initial expectations of a deficit. This result was driven by robust oil revenues, with average prices at $82 per barrel and disciplined expenditure. Total state revenues hit 12.78 billion Omani riyals, while public spending reached 12.24 billion Omani riyals, notably boosted by a 31% surge in development spending to 1.5 billion Omani riyals. Oman also reduced its public debt by over 660 million Omani riyals, bringing the total outstanding debt to approximately 14.6 billion Omani riyals. Qatar and Kuwait have officially signed an agreement to avoid double taxation on income and prevent tax evasion. The agreement was signed by the finance ministers of both nations. The deal aims to foster transparency through financial information exchange and boost commercial cooperation and investment between the two Gulf states. Goldman Sachs has stated that hedge funds bought global equities last week at the quickest pace since November 2024, just as stock markets ended the month with their most positive May performance in decades. It added that the funds ended the week bullish in every global region, led by North America and Europe. The bank noted that hedge funds are making their largest tech investment in 5 years, focusing on AI-critical companies like semiconductor and hardware manufacturers. Goldman Sachs further highlighted that companies in Spain, France, Finland, Germany, Sweden, and Denmark were the most net bought markets this week, while Ireland, the Netherlands, and Switzerland were the most net sold. Meta Platforms announced a 20-year agreement with Consultation Energy to keep a nuclear reactor in Illinois operational, marking its first direct deal with a nuclear power plant. The move aims to secure stable electricity for Meta's expanding AI and data center needs. The agreement will provide financial support for the Clinton Clean Energy Center's relicensing and operations after its state subsidies expire in 2027. This collaboration could set a precedent for other tech companies seeking to power their operations with existing nuclear facilities. Global stock markets displayed a largely positive performance on Tuesday. In the US, the S&P 500 rose 0.40%, Dow Jones Industrial Average Futures hiked 0.21%, and Nasdaq Futures inched up 0.70%. In Asia, Japan's Nikkei 225 edged down 0.06%, while Hong Kong's Hang Seng Index rose 1.53%, and the Shanghai Composite gained 0.43%. In Europe, Germany's DAX increased 0.50%, and France's CAC 40 climbed 0.26%, while the UK's FTSE 100 edged up 0.01%. This brings us to the end of our economic bulletin. Here's what we've been covering. Eurozone inflation falls below ECB target at 1.9%. OECD forecasts global GDP growth to slow to 2.9% in 2025 and 2026. And Turkish annual inflation eases to 35.41% in May. This concludes our economic bulletin. Don't forget to follow Qnews on YouTube, Facebook, X, Instagram, and TikTok at QNewsEG to stay informed. Thank you for watching and stay tuned for more updates on Qnews.